And I think that it was a much faster move that with our, convexity product, we managed to capture some of that. But because it was a short-lived move, or even like February 2018 as well, that's really too quick to be caught by most CTAs. So you just have to be careful of that there is protection, but it's a certain type of protection.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Hey everyone, and welcome to another edition of Top Traders Unplugged, where today Alan Dunn and I are joined by Philip Seager, Head of Absolute Return at Capital Fund Management, as part of our mini-series focusing on the one investment strategy that beat everything else in 2022, namely trend following and managed futures more broadly. First off, Phil, it's great to have you on the podcast. Thanks so much for joining us today. We really have been looking forward to our conversation. I hope you're doing well in Paris.
All is good. It's a pleasure to be here. Thanks for the invite.
Absolutely. Now, before we dive into all of the various topics that we're going to cover, Phil, I wanted to set the stage for the conversation and just give the audience a chance to learn a little bit about CFM and its background. So perhaps you can share just a few highlights maybe of the type of strategies that you focus on, and also kind of where the business stands today as we are in the early part of 2023.
Okay. No problem. So CFM started in 1991, and we actually started as a trend follower. So we had a CTA product. I joined the firm in 2000, and when I joined, so my mandate, my kind of first project was to diversify that futures program into short-term strategies on futures. So you can see sort of early on the business model was very much to diversify strategies, not because we felt that trend following was not a good strategy. It was just a question of like trying to stay ahead of the curve. And at about that time, we also diversified into other asset classes. So we started trading stocks. That was about 2001. So we had a startup. We started trading single stock options, which was about sort of 04, 05, about that time. So we had a vol into other liquid instruments like options on the S&P, options on treasuries, etc., plus many other kind of liquid instruments. So today we are really multi-strat, multi-asset. We have 9.5 billion under management, and about 1 billion of that is in two trend following products. One is a dedicated trend following product, and one is a convexity kind of defensive, crisis alpha product. We have about 60 researchers, and to do everything that we do, you need a lot of IT support. So we have about 120 ITs out of like total 250 people. We're based primarily in Paris, but we do have some research staff in New York, which is fairly recent, but we're looking to build that out.
That's wonderful. That's a great summary. And actually, it's really interesting because CFM in that regard is a little bit different to some of the other managers that we have been speaking to recently.
I mean, I think that, I've been listening to some of the other podcasts. I mean, I think that some of our viewpoints are potentially quite different to others, unconventional, perhaps not controversial, but somewhat unconventional.
Yeah, no, I can't. We can't wait to dive into to those differences for sure. And as then you will also know that Alan and I, we have this kind of list of major topics, and we'll dive in a little bit alternate and see where we go with that. So, as I always do at this stage, Alan, why don't I ask you to take it away from here?
Thanks, Niels. Phil, yeah, it's interesting. As you say, I can see how you CFM can be seen as being quite different. Obviously, you're running trend following, but it's, I suppose, as relatively a small component of the total assets that you're running. You're running kind of a number of different quant strategies. So what's the philosophy around that? That's we typically want to get a sense on the manager's philosophy around markets in general and where they feel they can extract returns in markets.
Mm-hmm. So in terms of our philosophy, what I would say is that we believe that inefficiencies do exist, but they are small and they're very difficult to exploit. We believe, at least for us, that a scientifically kind of rigorous investment process is the best way for us to proceed in extracting alpha. In order to do that, then we hire like PhD scientists, predominantly physicists, but more recently, in particular, like data scientists. Data scientists didn't really exist when I first started in this business, but that's certainly something that we've invested in. And we hire like PhDs because when you do a PhD, you're solving a very challenging problem, perhaps. Or normally it's a unique problem that nobody has solved before, and it's a very humbling experience. And these are kind of skills and values relevant to what we're trying to do. So we have a very collaborative kind of atmosphere. Teamwork is essential to what we're trying to do, and I think this is the way that science really progresses, and it's the same here. And in terms of regarding trend following, I mean, as I said, our flagship evolved away from trend following, and then in 2013 we launched a dedicated trend following program. And the reasons that we did that, firstly, we kind of saw a commoditization or a mutual fundization of this business. But then also we wrote a paper which was called 2 Centuries of Trend Following. You can kind of tell what we did just from the title. But that paper, I mean, the core result of that paper was a P&L of 2 centuries of data across the 4 asset classes: equity indices, fixed income, commodities, FX, and the core result was a very, very stable P&L through those 2 centuries, and that kind of deepened our belief in trend following as a good strategy. It's a big out of sample result. We had genuinely never seen that data, so that was like a big tick in the box for trend following. And in that paper, we also addressed the recent performance. So we wrote it in about 2012 or so, 2013. So that it was in that sort of barren period after the global financial crisis. So we addressed that period of underperformance as being like consistent with a statistical fluctuation downwards. We dealt with the robustness of trend following to timescales, which is a great thing about strategies. What we're always looking for is strategies that if they have input parameters, that you see stability to those input parameters, and that is the case for trend following. Obviously, the faster you get, the more you incur costs. And we also addressed like the disappearance of short-term trend following, which is something that happened. And we actually experienced that because our shorter-term strategies on futures really struggled at the beginning of the 2010s, albeit on a different timescale to what we were looking at in the paper. And then a third observation, which is a very important observation, is the regression of the SocGen CTA index. And we wrote another paper on that subject. So when you regress this index, which is a great index, 20 of the biggest names in this space, with trend following, then you get like 85, 90% correlation, and you get an outperformance. And that outperformance is about 4% per year. That's, that 4% essentially covers execution costs and fees. But that's quite a profound observation. Once you remove trend following from the aggregate CTA performance, there is nothing left. So what that means is, on aggregate, CTAs are offering nothing above and beyond trend following. Obviously, there are some good CTAs that outperform, and there are some that underperform, but the aggregate is not offering anything more. So with all that in mind, we launched a dedicated trend follower, and that is not a replicator. What we're trying to do is beat the SocGen CTA index with implementation skills, and we did actually achieve that. Regarding trend following, we're big believers that it should be a mainstay in institutional portfolios. I remember back in 2019 there was an episode where certain big names in this space publicly took a step back from trend following, saying that the trend was dead. At that time, we remained, firmly entrenched in the camp of trend following supporters for many reasons. But it really does tick all of the boxes in terms of statistical significance, in terms of out of sample performance, in terms of having an effect which is a believable effect behaviorally, and that's backed up by intuition and by experimental evidence. And then the diversification with the S&P, it is genuinely uncorrelated. And even better than that, there's a hedge in the biggest equity downside moves. And that sort of hedge is something, the convexity argument and the crisis alpha argument was a big subject for us. And hopefully we can talk more about that.
Great, an awful lot to unpack there, as people say. But I guess that the 2 centuries of trend following, that's very interesting. And a few different firms did a century or 8 centuries, or different kind of approached it slightly differently. But it is interesting how durable the return series from trend following is. With respect to that research, I mean, when you touched on how you could see the 2012-13 period was just a random, it was not unusual, I guess, in the long-term time horizon. Then I guess we had another drawdown, kind of 2016 to 2019. When you look at those periods of underperformance for trend, over 200 years, is it just random, or can you, people obviously want to attribute a narrative to good periods and bad periods, and I guess narrative that around those was maybe around central banks and maybe around less pronounced moves in markets. Would you buy into that, or do you just purely view it as, they were on the kind of the left tail of the distribution, and it is all just a bit random as to when the returns will arrive?
I mean, people will always look for a narrative, and we look for a narrative. We're not blinkered to what is actually happening in the market. We've thought to ourselves as well that perhaps policymakers are suppressing volatility, so maybe you can incorporate that into models, and models that could tell you when you should be in the trend and when you shouldn't be in the trend. But we never found anything that really pointed in that direction. So what we sort of, our view of this is that trend following has modest risk-adjusted returns, which are consistent really with the level of risk-adjusted returns that you expect from traditional markets. And with those levels of Sharpe ratio, you do get extended periods of time where nothing much happens. And trend following, it's a strategy that exhibits this feature of being positively skewed. And in order to be positively skewed, what that means is that you get accelerations upwards that exist for short periods of time, and then extended periods of time where not much happens, you're going to get flat periods. What we stated in the paper, and we stand by this, is that these sort of flat periods are consistent with the statistics. It's difficult to come up with a narrative that really explains, why such a period could exist.
And when you look at the 2010s, which, as I said, we kind of had two drawdown periods. I don't know if you can recall the data, but was there similar decades if you go back over the last 200 years, or how tough was that period? Would you say in the context of 200 years, if you can remember?
It's a very consistent result. It's the P&L is very consistent with a Sharpe ratio that is unvarying through the 200 years.
Okay. Oh, and is that about 0.5, 0.6, or what do you see that as?
So in the paper, I think the Sharpe ratio was 0.7, but in the paper it was an academic paper, so we didn't have costs and we didn't have fees. Our estimate of trend following provided to clients, net of everything, is a Sharpe ratio of 0.5. That's what we see consistently through time. Plus, when you look at hedge fund databases, like self-proclaimed CTAs and managed futures funds, what you see is that if you look at the distribution of Sharpe ratio versus the amount of time that the fund has been in business, you see a convergence to a Sharpe ratio of 0.5. And that Sharpe ratio of 0.5, okay, it's not like high octane stuff, but just to put things in perspective, if you look at the equity risk premium, it's, I would say, probably somewhat lower than that. It's probably 0.3, 0.4. So a Sharpe ratio of 0.5 in the great scheme of things is actually pretty good. Yeah,
and just one final one on this paper, because I think it is very powerful, but I guess people may be skeptical a little bit. 200 centuries, the markets were... 2 centuries, not 200. 200 centuries would be even more remarkable. But
that'd be a bit extreme.
Yeah, like markets were very different. We didn't have all the futures markets. Obviously you would have had to do some work on the data. So maybe tell us a little bit about what kind of adjustments you had to make, and how realistic do you think the data is going back that far in time?
Well, clearly it's not realistic that we could have run a business over that 200-year period. That's not realistic. But what is realistic, I think it's really a question of looking for evidence that this weak effect that price returns are autocorrelated exists today and has existed for a long period of time. So it may not be a completely meaningful result in the sense that you couldn't have operated a business all that time ago, but nonetheless, it's not meaningless either. It's a result that says that price returns autocorrelate in assets, albeit weakly, and they have done for a long period of time. And this is consistent with a behavioural bias that exists, that humans and investors have a propensity to follow trends.
Yeah, no, fair enough. Niels?
No, I want us to sort of go back a little bit here, Phil, because I find it very interesting that your roots really are trend following, and then you kind of take a little bit of you add other things to your business for a period of time, and then you kind of come back and you double down on trend and launch a dedicated vehicle for that. So a couple of questions. But first of all, I would also like to say that I really like the fact that you've done all this research and it kind of confirms your belief in trend. So one question I had is that when you look at your own business today, does it surprise you that trend is a relatively small piece of it, or is that just the way it is because trend is generally a smaller piece than than that. And then the second question would be, when you then relaunched a trend strategy in 13, was it really just taking what you already had, or did you come at trend with a slightly different approach than where you came from originally?
Okay, so great question. Why is it a smaller piece? I think that trend following has struggled in sort of adopting a role in traditional portfolios for a number of reasons. It's not as big a part of institutional portfolios as I would say that it should be. It's a strategy that as I've said, ticks all of the boxes. It's genuinely diversifying, genuinely uncorrelated, and even has features which are good in the tails. But I think that people do struggle with it. If you're not a disciplined investor and you are a performance chaser, then because of this profile, this positively skewed profile of the P&L, that's kind of a performance chaser's nightmare. I think a lot of people, they invest in it after one of these accelerations. So they're performance chasing perhaps after the global financial crisis, after 2014, or even after 2022. They stick around for a few years and remain patient, in inverted commas, and before the next acceleration, by the time the next acceleration comes about, then they've redeemed. So when they look back on their P&L through trend following, then it's actually quite poor, and I think that people struggle with that. Whereas my view is that it should really be a buy and hold. Obviously, I'm biased, but in terms of if I was managing my own money, and I've had this question before, out of all the strategies that you run, if you could only have one strategy, which would it be? And I think it's a no-brainer. It would be trend following, because it ticks the most boxes. Obviously, our business has evolved massively, beyond the trend following. But it's not because we don't like it. It's because we feel that we need to try and stabilize and increase the level of return. So we're diversifying into different approaches, different data sets, different techniques, et cetera, So a huge research process. But given the choice, out of everything that we do, I think trend following is probably the one that does tick the most boxes. So your question about, how we implemented it, did we do anything different? I think that, our added value in our trend following, dedicated trend following fund is, well, there's many things, but firstly, not falling into the pitfalls of in-sample overfitting. So there are many ways of doing trend following, and you can Google trend following, and there'll be tons of different ways of doing it. But it's actually quite easy to overfit, generate more performance in sample, and then you don't get that performance out of sample. So that is something that requires a lot of experience, is to exploit trend following in the right way, such that you get that out of sample performance, which is what we're all trying to achieve. But then I think as well that, our added value is everything that goes into building a product, which is to say portfolio construction, execution, all of the research that we do in those areas applies in our trend following product as well. So that is kind of how we set it up, is to try and use what we feel are good implementation skills to build a better trend follower.
Yeah, well, we may come back to that a little later in terms of how you may think of yourself as being slightly different. But I wanted to bring up something that we brought up with everyone, which is this Cliff Asness paper that came out last year, where kind of the key takeaways really is that on one hand, Cliff is saying that maybe we as an industry, we're just becoming too concerned about Sharpe, right? We're doing things to trend, to essentially maybe more for business reasons rather than for actual performance reasons, and that may be not a great thing. But then he also talks about whether we as an industry or as trend followers have a dual mandate. One is to generate absolute return, but also to generate this crisis alpha. And I know you already mentioned that. So, I mean, I would love to dig into all of these topics and see where we go with that.
Sure. So, we have a lot to say about convexity. We've written papers on the subject, and it's an interesting subject that trend following offers this. In our last paper on the subject, we had these rather beautiful payoff functions that you can generate that look like straddle payoffs, so you can make trend following look like option payoffs. But I think what people don't realize is that convexity is really a mechanical effect in trend following. So even if you apply a trend to a random walk, then you get to, sometimes the random walk kind of wanders away too far. And if that wandering persists on a time scale of your trend, then your trend following approach is guaranteed to make money. So that's where your large infrequent gains come from, and the rest of the time, because it's a random walk, then your overall P&L is zero. So the rest of the time you're losing. So you get small frequent losses but large infrequent gains. So it's starting to look like an option payoff. And that's really the difference with applying it to financial time series is that you get this positive P&L when you apply it to a diversified pool of instruments, and that's because of this behavioral bias, as I said. So it's kind of a minor miracle, really, that you get to a positive Sharpe ratio plus this convexity. If you contrast that with options where the premium is very pricey, you'll get a very strongly negative P&L if you buy options. But of course, the convexity is different in its nature. It's only convexity with respect to very long and drawn out protracted moves in the underlying. But our experience with clients, so we had some clients that would come to us to talk about the sort of Sharpe ratio of trend following. We would have some clients come to talk to us about the convexity. And based on our understanding of convexity, we saw that as a business opportunity to try to, in a very transparent fashion, maximize convexity in a product for a small reduction in Sharpe. So we say to our clients, we're going to reduce your Sharpe ratio and use that kind of discounted Sharpe to try and cram in as much convexity as possible. Convexity gets reduced by trend followers by doing a few things. I think the most interesting one is that the diversification. Firstly, that CTAs do trend following on a diversified pool of instruments. Now, your convexity on the S&P, which is what everybody's looking for, is limited to trending on the S&P, and if you diversify beyond trending on the S&P, then you're not adding extra convexity. So let's imagine that you add orange juice to your S&P, then you are adding convexity on orange juice, which maybe some people are interested in, but mostly people are interested in downside equity risk. So adding trend following on orange juice does not help you in terms of your convexity. And then we had also some clients that struggle with this kind of 2018 scenario where you get equities rallying and then equities crashing, like the VIX-Mageddon event. And as a trend follower, your P&L then looks very correlated with equities. We also added a constraint to the portfolio construction that makes sure that we have no exposure to equities. You end up with a product which is anti-correlated with equities. But all of this was in production through COVID, and we had very good results through COVID. But coming back to Cliff's paper, as you can tell, I'm on first name terms with Cliff.
We all are.
So AQR, they're a great firm. They're very good at timing their marketing documents in particular. I would say that our view is like, if you want trend following as a hedge, then we have a convexity enhanced product. If you want trend following for performance, then we have a different product. If you want something with a better Sharpe ratio and it's less correlated to trend following, then we have our flagship offering. So it all depends on what the client wants. I don't see why managed futures should be restricted just to trend following. We have many strategies in our flagship that are doing many things that have nothing to do with trend following at all. I don't know, esoteric example like using weather data to forecast commodities that really has nothing to do with trend.
Diving into research, you did make the statement about the pitfalls of kind of in-sample overfitting, which I think I get what you're alluding to, but maybe useful for listeners to kind of explain exactly what that might be in a trend following context. Is it just literally doing the back test and selecting the parameters that historically worked best? And if what is a better way of doing it, or what's the right way to do research in terms of a trend portfolio?
Yeah, I mean, I would say that in the business that I'm in sample biases are the biggest problem. It's the most pernicious bias that we have in doing research, and you kind of see when you have younger researchers that turn up that are very enthusiastic. They put together P&Ls and after doing this for 23 years, the amount of P&Ls that you see that are going up, and yet in production, in realized performance, we're nowhere near that. So there's clearly something going on. That you don't see what you see in your back test. So you always take back tests with a big pinch of salt. So I think the way around this, there's many things that we do to try and get around this problem. Trying as much as we can to do out of sample tests, trying to limit the size of the parameter set, get an understanding of the model, like let's say trend following is a good example, because if you understand where the origin of the effect comes from, so it's a behavioral bias, it makes a lot of sense, then that gives you extra confidence that it's an effect that is going to persist in the future. So all of that helps to generate out of sample performance. And in the context of the trend, what I mean really is that you can fool yourself. So let's say you have your benchmark strategy and you're trying to improve on your benchmark strategy. So you start changing parameters. Maybe there's like a Monday effect. So trend following works better on a Monday. So, you over allocate on a Monday and under allocate on the other days. But then you start to realize that it's not a statistically significant effect. But the problem is that you can sort of have many small or close to statistically significant effects, and then you start accumulating them, and your P&L gets better and better and better in the past, and that's not reflected in the future. So it's all of these types of problems and challenges that we have to deal with.
And so taking that mindset to the non-trend strategy, so do you need an intuition around why they work, or not, in terms of convincing yourself of their validity?
So it depends on the strategy. We do very different types of research. Often it's as a function of the timescale of the strategy. On the shorter term side, in our flagship program, we have shorter term strategies, and there you can do things with higher levels of statistical significance. So you're less reliant on actually having an understanding. And say for machine learning strategies as well, when it starts getting more black boxy, you would like to understand what the black box is doing. But if the performance is so good, it kind of negates the need to get an understanding of it. But then as you go out to slower and slower strategies, you don't really have that luxury. So there you really need to get an understanding of what you're doing, an understanding of what's driving the effect. So yeah, it really depends from model to model.
And then, so going back to trend, I mean, obviously, you want to avoid overfitting, tinkering with the parameters. So, what are the avenues for enhancing a trend program via research? And given that, you kind of want to do as little as possible with it, by the sense of it.
To some extent, yeah. The research that we do is very much dominated by work on our flagship program. Never say never in terms of what we do with the trend. We have made some changes in trend following. So we have a component which is more like a cross-asset trend within the trend program, but it's small in comparison to what I would call single assets, a traditional trend following approach. So really, you're right that the development per se, in terms of the research in signal development, is nowhere near what we do elsewhere in the firm. I would say the development is more in the other areas like execution and like portfolio construction.
Fair enough. And I mean, thinking about you touched on machine learning there, and that's been kind of I suppose some of our guests have found that helpful, some less so. I suppose what you can get with machine learning is that adaptive nature, reacting, shifting to a new environment. Is that not something you found success applying that in trend following, in terms of kind of picking up that markets are trending faster or slower, or anything around that?
So not particularly on timescales, but you can identify regimes where trend following works more or less well, but it's not a strong effect, and it's nowhere near as strong as the actual trend following effect itself. So we have toyed with that. I think the biggest effect is trend following. The second biggest effect is buy the dip type strategies, and the problem with buy the dip is especially when you get a crisis. So the S&P is tanking, and then you go in and you buy the dip. Where is the bottom? You can quickly find yourself in a position where you've come out of the trend, and perhaps you're even going long the S&P, and then the S&P is crashing. That's a very awkward position to be in. So these types of strategies, they're not trivial. We have found value in machine learning. It's not been a revolution. It's been a slow burn. I think that when we talk to clients, they think that machine learning is something quite new. I mean, when I was doing my PhD, I was using machine learning. It's been around for a long time.
Sure. Yeah. No. Absolutely. Yeah.
I think what has changed is really the availability of technology, computing power, the availability of recruits that didn't sort of know a lot about this, that know how to use the technology. The fact that you can do things on perhaps 2 lines of code when I first started, we had to code a lot of stuff ourselves. And now there's a lot of libraries that you can use to do this type of thing. But yeah, we see value in machine learning, less so on the strategy side, but a lot in execution, for example, where you're looking for shorter term predictors. The machine learning is very useful there. So it is definitely a growing component of our research.
Yeah, I wanted to ask you the first, a very selfish question, because it's a question I get a lot actually, and I'd also love to hear your kind of thoughts on this. If we just take 2022 as an example, everybody talks about it as being a great year for trend following, but it was also a year where we saw a lot of dispersion in returns between quote unquote trend followers. What do you think when you look at the landscape of peers drives what's the main difference you think you have or managers, trend followers have between them? What are the is it just the markets we trade? Is it times for speed of trend? I mean, what are the things that you think really makes a difference between one trend follower to another?
That's a good question. So yes, timescale. I would say that the portfolio of instruments, these are key differentiators, and we can delve more deeply into that. Actually, in preparation for this discussion today, we looked at the dispersion of CTAs historically and tried to see whether or not there was a pattern. And there is a slight effect. It seems that when volatility goes up, dispersion goes up, which I found a little surprising, but it's not that big an effect. So I think what's happening there is that the timescales may be slightly different. When you're in a crisis, some people get into position to benefit from that earlier than others. So there is a difference in the timescales. Our trend following approach is on a mid to long term frequency. The reason that we steer clear of the shorter time frames is one of costs. So you actually see a very stable performance in terms of Sharpe ratio across the timescales of the trend, as long as you don't go too short. But then you do see a big difference when you incorporate costs, because on the shorter time frames, you get more turnover, and that incurs more cost. But on our product where we're trying to create sort of equity downside protection, then we did fill in that sort of gap in terms of timescales to try to get more protection on a range of timescales. So I think it depends what you're trying to achieve as to what timescale you operate on, but there's clearly a difference across CTAs. And then in terms of the instruments that people trade, there's been a move towards what's now become known as alternative markets. Perhaps you could also refer to them as being illiquid markets. It's something that's it's a very interesting development. I think, if you consider alternative markets and kind of what the optimal amount of instruments that you should be trading is, then you should have as many markets as possible. If they're decorrelated, if they're uncorrelated instruments, then you should just add everything. And then if you consider the kind of a common correlation among markets, then the power of diversification is curtailed beyond a certain number of instruments. But then liquidity is a real problem. I think that our focus has been on costs and liquidity, perhaps more than others. When you add illiquid instruments, that's quite a risky endeavor. The point that I would make is that when you're trading illiquid instruments, and what we've seen is that the performance of alternative market CTAs has been quite good, but as there's a flow of AUMs that can move into that space, it's potentially that the performance is actually coming from a flow of AUMs, a steady flow of AUMs that's pushing prices in the direction of their position, so you can generate performance like that. And if ever that flow of AUMs were to stop, then there could be quite a brutal decay of the impact in illiquid markets, will send performance in the opposite direction. So it's an interesting development, and then I would say as well that the danger is that the more diversified your pool of instruments becomes, the less convexity you get, the less defensiveness you get, the less equity downside protection you're going to get. With the example that I gave of orange juice, trending on orange juice does not help you to protect against equity, S&P downside. As you go to more and more esoteric portfolios, then you get less and less convexity, and that's perhaps what we saw last year in 2022. Was that the more illiquid sort of alternative market offerings, that their performance, albeit positive, was not as positive as on the liquid markets.
Yeah, no, absolutely. Now, one thing I've certainly learned to appreciate in my career in this industry is that, the devil really is in the detail. Yet most of the conversations, I think most of the understanding or the way people think about trend following often goes to the actual kind of signal generation. Are you using moving averages, breakout, time series momentum? What are you doing? But there are many other parts of what we do. I'd love to hear your thoughts about how the importance you put on things like correlation, volatility, the choices you make about these things. How much do you think that actually moves the needle relative to whether you're using one type of trend following to another, so to speak? So I'd love to hear your thoughts about that.
Yeah, so I think I would group that under a category of risk control. How do you do your risk control? So yeah, historically we've put a lot of effort into understanding correlations, into cleaning correlation matrices, reducing the amount of noise in the measurement of correlations, and that certainly helps. We see value. I think you need to be able to estimate the correlations and clean your correlation matrices, but you also need to get estimates of volatility. I think the volatility estimates need to be somewhat more prompt in terms of being able to deliver your targeted risk. So what are we trying to do with our risk management? We're trying to keep risk stable. We're trying to hit a target, and we don't do that for fun. It's more like it does give us better risk-adjusted returns. When you back test, keeping risk stable is better for outcomes. And you think about what we're trying to maximize with our risk management. I think what we're trying to maximize is sharp while controlling the tails. So like you could think of it as being, perhaps sharp over kurtosis, like fat tails, a measure of fat tails. So you're trying to minimize the fat tails and maximize the sharp ratio. And we do that algorithmically. I think that would come as no surprise. But we also do, because our risk modeling is backward looking, necessarily there's things that are happening in the market that we're aware of that our risk model is not aware of. So we do also try to forecast gaps in the market, the potential for tail events. And we do that by sitting around a table in a committee. So I sit on that committee. We've discussed such things as like the Bank of Japan recently, coming out of the yield curve control that they've been operating. Also through COVID, what could potentially happen in terms of tail events, and looking forwards, the debt ceiling that is coming up in the US, could that potentially create a tail event? So yeah, obviously we're doing everything algorithmically, but I think that side, trying to understand, being aware of what's happening in the market is also very important.
Okay, yeah, that was actually one question I wanted to just maybe ask you, because I wasn't entirely sure. So what you say is you're aware of these, but you actually, the system runs as they should, or do you intervene?
We intervene.
You intervene. Okay.
Yes.
Okay.
So,
okay.
For example, the Bank of Japan, what they were doing in terms of yield curve control, we stopped trading the JGB.
I just wanted to move on and talk about kind of the role of the trend and managed futures in a multi-asset portfolio, because Phil has touched on a few of these kind of topics already. Obviously you mentioned you've got, I don't know if you call it vanilla trend or your kind of flagship trend, and then you have the more defensive trend with the capped equity beta. Is that, do you see that as driven by investor demand, or if you were running a simple multi-asset portfolio, stocks, bonds, and adding something to it, do you think it's better to go with something where the trend has the equity exposure curtailed or not?
So we did obviously a lot of research on this point, and what we did was to take so we have a dedicated trend following program. We have a kind of convexity enhanced program, whatever you want to call it, and we have equities, and you could even throw in a 60-40, which tends to be quite correlated with equities anyway. But whatever your preferred benchmark is, and then try and see based on various metrics what the results are when you combine everything together, and so that required a certain amount of thought as to what metrics it is that you're really trying to maximize. So the way that we thought about the problem was, rather than looking at Sharpe ratio, is to look at Sharpe ratio also incorporating drawdowns in various forms, because it's not easy to sort of get a handle on drawdowns. So we started thinking about, if you can look up the Sterling ratio, and that it's like a gain over drawdowns rather than gain over volatility, but it's similar in spirit to what we were trying to do. But then how do you define drawdowns? That's really the problem. So we had various definitions of drawdowns. In the absence of knowing, like having a dogmatic view, then you kind of average over several different definitions, and that's what we did. And yes, it confirmed that our equity downside protector was better in the mix when picking these types of metrics that incorporate drawdowns. So that's the way that we dealt with it.
Okay, and I'm guessing then if you were looking at the total portfolio, say 60-40 plus trend, if you were just looking at the compound annual growth rate, forgetting about drawdown, you would be better off with your normal trend unadjusted. Is that fair enough?
Better off, or not much difference. let's say.
No, okay, yeah. And you talked a bit about the convexity in this example of adding orange juice or not, but is it not? Our experience is often that actually when you get these equity drawdowns or equity sell-offs, it's actually the non-equity markets where you get the big moves. So, COVID, for example, the commodity markets started showing evidence of the problem. Obviously, they were very China sensitive in kind of January, February of that year, and obviously you tend to get moves in bonds. So is that not an important source of the return profile, which gives managed futures and trend following it's this convex profile?
That is indeed the case. Strictly speaking, the convexity comes from trending on equities, but what you know is that things will be correlated. So you get correlations in the tails. In particular, I think through COVID, the bigger contributor was actually fixed income. So yes, you get convexity through correlations with other instruments, but the more esoteric the instrument gets, the less the correlation is, and the less effect you get. I mean, these moves in commodities. We wrote a paper on the fact that I think that what actually happens with commodities, if you're trending on commodities, you actually get a hedge against inflation, so convexity against inflation. If you try and model inflation, then you see that it's very well modeled by commodities. It makes a lot of sense. So if you just regress CPI with all of your instruments, you'll see that commodities are really dominating the explanation of CPI. So when you're trending on commodities, you're actually, like, you can think of it as being trending on inflation. So in the big moves in inflation, up and down, then you get protection. So you're getting that convexity on inflation as well, which is also a great thing. I think probably most people don't realize.
Yeah, and maybe just one final one on this topic of using trend within a multi-asset portfolio. Obviously we've talked about how you can cap the equity beta, and really what we're talking about here is dealing with this kind of 2017, 2018 type scenario where trend following becomes correlated with equities, and then you're worried about both of them turning down at the same point. Have you looked at other things, other ways of possibly solving this problem of either adjusting the risk, so maybe having less risk in trend at that time, or also maybe adjusting the speed, but so still trading all the markets, but making some other adjustment to how trend operates to avoid that kind of concurrent drawdown with trend and equities?
So we have looked through the history of the firm at such things, but yeah, it's very, very difficult to sort of time and to know ahead of time. It's tautological that as you look back, then one timescale was better than others, but to actually do that causally, or what I call causally, without sort of that the benefit of hindsight, it's very difficult to capture that effect.
Yeah, before we sort of start wrapping up our conversation, Phil, just a couple of things. One of the themes that we are picking up from our conversations is really that a lot of the larger managers, a lot of the kind of managers in the CTA index whom we're speaking to, saw flows head out of trend last year, most likely because investors were, rebalancing their portfolios, etc. But it kind of also, touches on a little bit the point about sort of just generally capacity among managers and strategies, et cetera, et cetera. So I'd love to hear your thoughts a little bit about what's a good measure. How do managers find out whether they are, near or at capacity in general? And then the other thing I wanted to ask you, because maybe some of the assets flew out of or some of the larger managers, but we did see that replication products did see an inflow, probably from a completely different investor base, namely the individual investors. But since you are, much more of a quant than Alan and I can claim, I wanted to ask you, what are the pitfalls, potential pitfalls of doing replication on managers when you only look at some kind of regression of returns, when you're not actually building your own model beneath that? Because, I guess my own concern is that we may see a big inflow into these replicator products because they promise that they can deliver kind of everything but the fees, so to speak, which we can always debate. But it would be a great shame if there was, and they kind of, I like the people who do it. They come on the podcast on a regular basis, so I have to be political correct when I say this. But of course, one of their pitches is that, oh, you have this manager risk, right? Just because XYZ did well last year, you don't know if that person is going to do well next year. Sure, but what about the replicator risk? I mean, there must be a risk somewhere if you're choosing one way of doing replication that could also, get you into trouble. So that was a lot of question in one sentence, Phil. So pick whatever you remember from it and let us know.
So, going back to how you started this question, so rebalancing. Indeed, we have seen some rebalancing. That's definitely the case. I find it interesting that clients will rebalance their equity portfolio. So when they see downside risk in equity, so they get losses from equities, and then they reinvest. You never see that with trend following. So when trend following underperforms, they never reinvest in trend following. So I think, again, it's kind of a sign that there's not really traction in institutional portfolios for trend following. On the subject of capacity, so the capacity of trend following, it's an interesting question. It's always an interesting question where your capacity is for a strategy or for a product or a program. As a scientist, you'd kind of like to run an experiment and go way past your capacity to see where your capacity is, but obviously that's not a good business model. But so trend following it's a funny animal, really, because it's not an arbitrage. It's not you're not taking advantage of a mispricing. And just modeling trend following, you do see that if you add more trend followers to a market, then you get better performance. So the mechanism for removing the trend signal from a market through an excessive amount of people is not really there. So the capacity, I would say, for mid to long term trends is higher than most strategies because, firstly, it's a directional strategy, so you don't really have to run market neutral portfolios. It's something that naturally lends itself to generating a lot of risk, so you don't need a lot of growth to be able to do it. And also the fact that you're trading the most liquid instruments in the world. These are the deepest markets in the world. So the capacity of trend as a strategy is actually high. When we estimate capacity, I think that what we tend to do is really just base it on our experience as much as anything. We also, as a firm, we have the benefit of running higher frequency, faster strategies. So we have a huge database of the trades that we've done, often quite sizable trades. So we feel like we have a control over our execution. So potentially kind of scaling up the strategy in your back test, you feel more comfortable doing that. And then on the last point, so replication issue, so we have not built a replicator. I'll just state that again. What we're doing is we feel that we can offer the market a very good trend following dedicated trend following program. The risk of these replicators, I would say, is really, the implementation skills required to do this. It's a negligible amount of work that gets put in, many millions of dollars invested into building these types of programs. So I would say that the main risk in investing in a replicator is that you're not investing with someone who has that skill set. Yes, you can regress, and they can offer you a product with very low fees, but just be careful of the fact that the cost may well be in the fact that you do not deliver the performance longer term. So that's what I would say.
Yeah, no, I appreciate that. Final question, Phil, and that is just something we wanted to ask everyone in this series, and that is, what's the one thing you hear about trend following that you disagree with the most?
So I'll give you perhaps a few.
Oh yeah, sure.
Firstly,
more than one.
Firstly, that it's easy. I really don't think that it's easy. You could come up with a naive P&L, but then going from that through to something which is implemented and actually generating, a reasonable degree of risk-adjusted returns, that's not easy. So, perhaps I'm repeating myself, but don't underestimate the importance of implementation skills. Also, I think that there's sort of perhaps a level of naivety on the convexity, the downside protection that you get from the trend is that it may be a mechanical effect, but it still remains statistical. It's not the same thing as options. If you want the insurance, then you have to buy options and pay the premium. And that gives you guaranteed payout when the thing that you're insuring against actually happens, meaning the equity crash. In the case of trend, you get that protection when, it's a path-dependent thing. So when markets are in that sort of long and protracted drawdown, which is kind of often the case, you see crises tend to play out on long timescales. You look at the global financial crisis, that's what happened, and that's why the trend did very well. But the kind of CTA business did less well through COVID, and I think that it was a much faster move that with our convexity product we managed to capture some of that, but because it was a short-lived move, or even like February 2018 as well, that's really too quick to be caught by most CTAs. So you just have to be careful of that there is protection, but it's a certain type of protection.
Yeah, no, absolutely. Phil, this was a great way to wrap up a fascinating conversation. Thanks so much for being on the podcast and for sharing your thoughts and insights with us. And we hope we can do this again sometime in the future. And to all of you listening today, I hope you're able to take something from today's conversation onto your own investment journey. And if you did, please share these episodes with your friends and colleagues. From Alan and me, thanks so much for listening. We look forward to being back with you on the next episode of Top Traders Unplugged as we continue our deep dive into the CTA industry. And in the meantime, go check out the show notes for this episode and all the other resources that you can find on our website. And as usual, not least, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.